The origins of Peter Lynch's six-category strategy. Peter Lynch stands as one of the most celebrated investors in history, not because he relied on complicated formulas or secret market algorithms, but because he redefined how investors think about the stocks in front of them. During his legendary tenure leading the Fidelity Magellan Fund from 1977 to 1990, he delivered an average annual return of 29%, an astonishing achievement that nearly doubled the S&P 500's performance over the same period. While many admired his success, few truly understood the foundational system that enabled him to evaluate companies with such clarity, the six-category stock classification framework. In Lynch's belief, every company that appears on an investor's radar belongs to one of six main types: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. This was not just an academic tool, it was a way to eliminate confusion in the decision-making process. Many investors make the same mistake: they treat all stocks as if they operate under the same conditions and growth logic. Lynch realized that the stock market is not a uniform battlefield. Different companies grow differently, respond differently to the economy, and require different expectations. Without categorization, an investor risks expecting fast growth performance from a slow growth business or ignoring the cyclic nature of industries prone to economic swings. Lynch's philosophy began with deep observation of companies, how they actually operate in the real world. While many Wall Street investors isolated themselves from consumers and daily life, Lynch absorbed insights directly from store shelves, shopping malls, neighborhoods, and the products used by everyday people. But even after identifying a promising business in daily life, Lynch insisted that investors must first classify what kind of business it is. That classification directs everything: valuation metrics, expected returns, risk tolerance, and holding time frame. A slow grower should not be judged the same way as a fast grower, because the potential upside is drastically different. A cyclical stock requires careful timing, while a stalwart can be a long-term backbone of the portfolio. Lynch's real genius was making investing approachable for ordinary people. He was not impressed by someone who bragged about an advanced financial model. Instead, he admired investors who could explain in simple terms why a company's stock would rise. His six stock categories are therefore both a mental model and a risk management tool. They filter out unrealistic expectations and focus the investor's mentality on what matters. Meanwhile, stalwarts are sturdy but not spectacular. They are stocks that deliver steady appreciation and protect capital during market turbulence. Lynch believed that every retail investor, especially those without access to Wall Street research, must rely on categorization as their foundation. When you know what type of company you own, the stock market becomes far less frightening. Panic selling declines, confidence increases, and investment decisions become grounded in rational expectations rather than emotional reactions. Many modern investors chase trends without understanding business fundamentals, and Lynch warned that this behavior leads to unnecessary losses. A disciplined investor, on the other hand, embraces simplicity. What kind of business is this? How much can it realistically grow? What specific catalyst will increase the stock's value? These questions become answerable once the company is categorized correctly. Lynch's own journey into this framework was shaped by observing mistakes, his and others. Early in his career, he realized that buying a slow-growing company expecting rapid expansion was a losing game. He saw traders panic selling cyclical stocks at the bottom of the cycle when they were instead undervalued opportunities. He recognized that some companies with strong asset values were ignored simply because their profits were temporarily weak. Over time, Lynch refined his classification system into the six categories now recognized globally as a core value-oriented investing methodology. His categories also remove the illusion of predictability. Investors often believe that if they like a company personally, the market will too. Lynch rejected that thinking. A company must show numbers, management skill, a durable competitive advantage, and a properly matched category before receiving an investment dollar. Identifying the category is like diagnosing a patient before prescribing treatment. Without a proper diagnosis, even a great medicine can be harmful. That's how Lynch viewed stocks. A mismatched strategy leads to poor outcomes. Despite his fame, Lynch never considered himself a market predictor. Instead, he viewed investing as detective work. The category tells you where to search for clues. A turnaround demands tracking debt reduction and strategic improvement. A fast grower demands monitoring expansion and innovation. An asset play requires uncovering hidden value the market has not yet recognized. Most importantly, Lynch taught that categorization is fluid. Stocks evolve over time. A fast grower can become a stalwart. A stalwart can become a slow grower. A turnaround can become a bankruptcy, or a fast grower again. The skilled investor adjusts expectations accordingly, while the unskilled investor remains stuck in outdated assumptions. Lynch's 6-category strategy became a masterpiece because it merged simplicity with practicality. It allows anyone, from a beginner investor to a Wall Street professional, to approach the complexities of the stock market with a structured system. This structure leads to confidence, clarity, and consistency, 3 traits that separate long-term winners from anxious short-term gamblers. As we move into the detailed breakdown of each category, the real question for every investor becomes, which of these business types do you truly understand? And which ones best suit your temperament and goals? Because Lynch did not just give a framework for companies, he gave a mirror for investors to understand themselves. A great investment strategy is not just about selecting the right company. It is about selecting the right company for you. And that begins with knowing the category. The 6 categories explained, how investors should think like Peter Lynch. Peter Lynch's 6-category system stands as a roadmap for investors attempting to navigate the unpredictable world of equities. Rather than applying the same expectations to every stock, Lynch taught that understanding a company's category determines how you measure success, how long you hold, and how you respond during volatility. This framework is not just theory, it's a practical tool that informed his decisions while leading the Magellan Fund to historic success. Let's break down each category and reveal how Lynch believed investors should think when buying stocks. First, we have slow growers. These are mature companies, often in industries with limited expansion opportunities. They typically grow slightly above inflation, perhaps 2% to 4% annually. Lynch believed slow growers once had their high-growth era, but that time has passed. They still produce profits and often pay reliable dividends, but they will not deliver explosive returns. Utility companies, large grocery chains, and long-established telecommunications firms often fall into this category. Lynch did not dislike slow growers, but he saw them as income plays rather than wealth builders. He warned investors not to hold unrealistic expectations. A slow grower will not triple in 5 years. You buy it for stability and modest compounding, not excitement. The real danger is mislabeling. Thinking a slow grower can behave like a fast grower leads to disappointment. Next comes stalwarts, strong, financially healthy industry leaders with consistent growth. These companies grow faster than slow growers but not at high-growth startup pace. Their earnings typically rise 5% to 12% annually. Lynch described stalwarts as reliable performers that protect portfolios during downturns. Examples include Coca-Cola, Procter & Gamble, and Johnson & Johnson, brands with global dominance and pricing power. When markets crash, stalwarts shine, because people continue buying toothpaste, beverages, and household essentials regardless of the economy. Lynch believed stalwarts are core holdings, stocks to hold long-term and even add to during market weakness. But he warned against overpaying. If the valuation becomes excessive, returns shrink dramatically. Then comes Lynch's favorite hunting ground, fast growers. These are the crown jewels of Lynch's strategy, companies growing earnings 20% to 40% annually. Small to mid-sized businesses with strong expansion potential, innovative products, and rising market share. Fast growers can turn a modest investment into a fortune. Think of early Starbucks, early Home Depot, or early Netflix, businesses that scaled rapidly across the nation or globally. Lynch famously called these 10-baggers, meaning stocks that grow tenfold. But these companies also carry risk. Competition can quickly erode growth. Lynch demanded ongoing research. Is this company still expanding? Has growth slowed? If a fast grower matures, it must be reclassified. It cannot stay in the fast growth category forever. A failure to recognize that transition destroys profits, because investors hold on hoping past performance continues endlessly. The next category, cyclicals. These are companies whose performance rises and falls with economic cycles, automobile manufacturers, airlines, construction firms, and luxury goods producers. Cyclicals surge during booming economies but crash when demand drops. Timing is everything. A cyclical bought at the peak is one of the worst investments imaginable, but the same stock bought during a downturn can deliver massive returns. Lynch cautioned that casual investors often misjudge cyclicals by assuming rising profits will continue indefinitely. The smart investor must understand the cycle phase. Is this the beginning of recovery, the middle of expansion, or the brink of decline? Lynch compared cyclicals to roller coasters. You must know the track, or you'll regret the ride. Then we move to turnarounds, broken companies that still have hidden potential. They may be losing money, burdened by debt, trapped in declining industries, or suffering from mismanagement. But Lynch looked for catalysts, a new CEO, smart restructuring, asset sales, or a new market opportunity. Turnarounds are high risk, high reward. Some can become fast growers, while others go bankrupt. Lynch described them as the injured athletes capable of unexpected comebacks. The key question is, can this company survive long enough to recover? If yes, the upside can be enormous. If not, total loss is likely. This category requires courage and realism. The final category is asset plays, a type many investors overlook. These companies hold valuable assets not reflected in the stock price. For example, real estate holdings booked at outdated historical values, stakes in other companies, massive cash positions, mining rights, or intellectual property. Lynch viewed asset plays as hidden treasure, opportunities where the market hasn't recognized true worth. But uncovering these plays requires detective work, deep research, reading financial statements, searching for undervalued property or overlooked business segments. Lynch believed asset plays offered one of the best margins of safety, because real value supports the investment, even if earnings fluctuate. The magic of Lynch's strategy lies not just in identifying a category, but in knowing what action follows. With slow growers, dividend income matters. With stalwarts, patience and buying during dips matter. With fast growers, continuous monitoring of expansion matters. With cyclicals, timing matters more than anything. With turnarounds, identifying survival and catalysts matters. With asset plays, valuation discipline and discovering hidden value matters. Lynch wanted investors to align expectations with reality. He asked, "Do you know what you own? And why you own it?" Most investors do not. They panic when performance does not match the fantasy they invented. Lynch eliminated fantasy by assigning every stock a category before buying. Another key concept he emphasized: your portfolio should not rely too heavily on one category. A portfolio filled only with fast growers is explosive but fragile. A portfolio filled only with stalwarts is safe but slow. Lynch recommended balance, mixing opportunity and security. He also acknowledged that categories change over time. The investor must evolve too. A fast grower that slows becomes a stalwart. Cling to old assumptions and you lose money. A cyclical entering a downturn must be sold, even if you love the business. A turnaround that succeeds may graduate into a fast grower with an entirely different risk profile. Many modern investors struggle because they hold emotional attachments and ignore category shifts. Lynch separated emotion from strategy. Growth changes, risk changes, valuation changes. The category must change accordingly. Lynch's brilliance was in making complex thinking simple enough that anyone could apply it. Even a beginner investor can ask, is this company growing fast or slow? Does the economy heavily impact its performance? Does it have assets not yet priced by the market? Is it recovering from decline? Is it a leader in its field? These simple questions form a multi-billion-dollar investing methodology. Lynch's 6 categories remain profoundly relevant today, even with tech startups, international growth markets, and new business models emerging. Why? Because human business behavior has not changed. Economies still cycle. Companies still rise and fall. Growth still matures. Risk still needs classification. The investor who understands business categories understands the stock market, not as chaos, but as organized opportunity. And that is why Peter Lynch changed investing history, not by making it more complicated, but by making it crystal clear. How to use Lynch's strategy to build real-world wealth. Peter Lynch didn't just categorize companies, he gave investors a practical playbook to build life-changing wealth. His 6-category system was meant to be applied using personal observation, common sense, and continuous research. Lynch believed that investors have powerful advantages they often fail to notice. You see products in stores before Wall Street does. You hear consumer trends in your community before analysts release reports. Everyday experiences can reveal investment opportunities faster than any chart or financial model. Lynch famously said, "If you stay halfway alert, you can find extraordinary companies right under your nose." That means when a restaurant chain is always full, when a clothing brand goes viral, when a new tech product spreads rapidly, those are signals. But observation alone isn't enough. Lynch demanded verification. Before buying, classify the company. Is it a fast grower? A stalwart? A cyclical? Each category shapes your expectations. Without categorization, investors fall into traps. They expect cyclical profits to grow endlessly. They treat a slow grower like a rocket ship. They hold a fast grower after growth ends. Lynch insisted, know what you own, and why you own it. Once the category is clear, Lynch used valuation and growth comparisons to determine whether a stock was attractive. His favorite tool was the PEG ratio, price-to-earnings ratio divided by growth rate. If a company's PE is 20 but its earnings grow 20% every year, PEG equals 1, which Lynch considered fair or even cheap. But if PE is 40 and growth is only 10%, PEG equals 4, far too expensive. Price matters. Even great businesses can be terrible investments if bought at the wrong time. Lynch reminded investors that excitement often destroys returns. The more exciting the story, the higher the price, the lower the future returns. He was a master of separating the hype from true potential. In practice, Lynch always asked, does the company have a strong balance sheet? Low debt? Good cash flow? Room to expand? Durable competitive advantages? A great brand? These fundamentals differentiate real opportunities from short-lived fads. Another critical Lynch principle, winners cover for the losers. He recognized that not every investment succeeds. Some fast growers collapse. Some turnarounds never recover. But if one stock becomes a 10-bagger, a 10x return, it can offset multiple disappointments. That's why investors must allow great companies time to compound. Selling early is one of the biggest mistakes. Lynch believed selling too quickly kills wealth. You only need a few good stocks in your lifetime. But you need to let them grow. This is where investor psychology becomes essential. During declines, fear pushes people to sell at the worst possible moment. Lynch encouraged patience. Downturns are opportunities. If a company's long-term story remains intact, temporary price declines are gifts. Many investors panic because they don't truly understand the business they bought. Lynch argued that conviction comes from knowledge. When you know a company deeply, its market, its strengths, its growth drivers, you stay confident through volatility. Long-term thinking isn't just a strategy, it's a mindset. Lynch also warned against information overload. Investors can be distracted by news, predictions, and market noise. He said most predictions about the economy or rates are useless. nobody can predict interest rates, the economy, or recessions. Focus on the companies. Lynch ignored macro panic and concentrated on business reality. If a company kept selling products, increasing earnings, and growing customers, he stayed invested. Simplicity over speculation. He encouraged regular people not to underestimate themselves. Professionals often overanalyze, complexity becomes a disadvantage. Individual investors have the agility and independence to act on their own understanding. In many ways, Lynch democratized investing, proving that average people could beat the market. Another crucial element, continuous monitoring. Categories shift. A fast grower eventually slows, becoming a stalwart. A stalwart might decline, becoming a slow grower. If a cyclical nears a downturn, selling before profits collapse is essential. Lynch believed the investor must evolve with the company. Stagnation leads to losses. Flexibility preserves profit. Lynch's methodology offers a balanced blueprint. Slow growers bring stability. Stalwarts protect during recessions. Fast growers create massive upside. Cyclicals offer short-term trading opportunities around economic cycles. Turnarounds provide high-risk opportunities with transformative potential. Asset plays give undervalued protection and hidden rewards. The strongest portfolios use all 6 categories intelligently, managing risk while unlocking growth. The beauty of Lynch's philosophy is that it doesn't require genius. It only requires curiosity, discipline, and rational thinking. You don't need Wall Street connections, you need eyes open in your daily life. You don't need to predict markets, you need to study businesses. You don't need to outsmart everyone, you need to avoid emotional mistakes. Lynch proved that investing success is not about luck, it is about consistent, informed action over many years. Compounding rewards those who wait. Every year of growth adds to the base, making progress accelerate exponentially. But impatience kills compounding. Selling too early sacrifices future potential. Peter Lynch became legendary because he respected time more than timing. He built wealth not through prediction but through preparation. Not through speculation but through understanding. His message was clear: stay engaged, stay rational, stay long-term. As he once said, the real key to making money in stocks is not to get scared out of them. So the question becomes, will you treat investing like gambling? Chasing price movements and CNBC headlines? Or will you think like Peter Lynch, studying businesses, categorizing wisely, and letting compounding work its magic? The investor who follows Lynch's strategy doesn't merely buy stocks. They buy a piece of businesses they believe in. They invest with intention. They invest with awareness. And over time, if they follow the category framework, keep learning, and remain patient, they build true wealth. The message Lynch leaves us with is simple yet profoundly powerful: opportunity is everywhere for those willing to look, think, and act with conviction. Every investor must choose, panic or patience. Noise or knowledge. Hype or homework. The answer will determine not only returns, but financial freedom. The path is clear. The map exists. Now it is in your hands. Thank you for joining us on this deep dive into Peter Lynch's brilliant investing philosophy. If there is one lesson to take away, it's this: extraordinary opportunities are often hidden in ordinary life. The companies you trust, the products you use, and the trends you notice before the rest of the world, those may be the keys to your financial success. Investing isn't about guessing the future. It's about understanding the present. Keep your eyes open. Keep learning. And most importantly, stay patient. If you found value in this video and want to continue exploring the minds of legendary investors, make sure to subscribe to the channel. Your journey to smarter, more confident investing starts here. See you in the next episode.